Hello class, and welcome to the video lecture for Corporations and Bonds Payable. The last learning unit covers journal entries for the retirement of bonds and sinking funds. Remember that the term retirement, when used with bonds, means to take the bonds off the accounting books. So far you've learned about retiring bonds when they reach maturity and the bond is fully amortized. That journal entry consisted of a debit to bonds payable and a credit to cash. Sometimes a corporation will retire a bond before its maturity. Bonds that enable a corporation to do this are called callable bonds. The corporation is permitted to reacquire the bonds at a price based on a percentage of face value. Sometimes corporations will retire bonds and reissue new ones to take their place, paying a lower rate of interest. If this call provision doesn't exist, a company can repurchase its bonds in the open market and then retire them. By retiring bonds, companies can decrease the amount of debt they owe. If the stated interest rates of the bonds are high, the retirement of bonds could result in substantial cash savings, even if new bonds are issued at lower rates. When a bond is retired before its maturity, three things need to happen. First, any amortization of discount or premium must be brought up to date at the time of retirement. Second, the premium or discount, as well as the bond liability account, must be removed. Third, any gain or loss is recognized. On page 725, where your textbook lists these three items, it also says the gain or loss is listed as an extraordinary item that's shown on the income statement. I would like you to disregard that because that rule was changed in 2007, and now gain or loss from the retirement of debt is listed as extraordinary only if it meets certain criteria. That's an advanced topic that I don't expect you to know. Please just focus on the journal entry, which will include a gain or loss, and don't worry about where it's supposed to be on the income statement. Let's look at the example in the book. On June 30th, a corporation retired a $500,000 10% bond that had an unamortized premium of $19,000. The bonds were called in at 105, which is 105% of face value. All journal entries relating to interest payments and premium amortization were completed before the bond's retirement. The entry to record the retirement of the bonds would be a debit to bonds payable to reduce the bond payable account to zero, a debit to premium on bonds payable to reduce the premium account to zero, a credit to cash of $525,000, which is 105% of the face value of the bonds, and the difference between the total debits and total credits of the journal entry, which is $6,000, is a debit. When the difference is a debit, it's a loss. Now let's look at bond sinking funds. Often a corporation will be required to establish a separate fund that will accumulate cash over the life of the bond. The cash accumulated is then used to pay off the bondholders at maturity. This is a way to ensure that the money needed to pay off the bond is available at maturity, like a savings account. This bond is called a sinking fund. It's recorded as a sinking fund in the accounting records and placed in a separate interest-earning bank account. When interest is earned on the balance in the sinking fund interest earned account is credited. Sinking fund earned is another revenue account. Let's look at an example. So Morel Corporation issued 8% 15-year bonds for $80,000, agreeing to deposit $2,946.40 at the end of each year during the lifetime of the bond, so that by the end of the 15th year the fund would contain $80,000 to pay off bondholders. To record the entry for the deposit, every year we debit the general ledger asset account called sinking fund and credit cash. When interest is earned on the balance in the sinking fund interest earned account is credited. In this example, the savings account containing the sinking fund cash earned interest of $235. And 71 cents. $235 and 71 cents. The journal entry to record the interest is a debit to the general ledger sinking fund account, because that's where the bank deposits the interest income, and a credit to a revenue account called sinking fund interest earned. In this example, the fact that the bonds are 8% and the interest rate is 8% is coincidental. Finally, we have the journal entry to record the retirement of the bond and the bonds are paid off. We record a debit to bonds payable to bring the bond payable account to zero. We credit the bond sinking fund because that's where we held the cash to be used to pay the bondholders at maturity. And the balance in the sinking fund account is $80,050. In this case, the company saved a little too much in the bond sinking fund account, so the extra goes back into the regular cash account, which is $50. So we debit cash for $50. One last comment about sinking funds. Sinking fund accounts are the same as cash. It's just that the account name isn't labeled cash. A company might have several different bank accounts containing cash, and they all must be labeled something different in order to keep track of them. A cash account doesn't have to have the word cash in it.